truth is, a lot of persons invest based on social media hype, trends, or because their friends told them to buy a stock. But smart investors do something differently. Before they invest, they check if the company is actually profitable. And in today's video, I'm going to show you 10 powerful things you must check before investing in any company. These are the exact type of things wealthy investors look at before buying stocks. And trust me, if you understand these points, you will avoid making bad investments. Make sure you watch till the end, because the last point might save you from losing money. And if you're just meeting for the first time, come closer. My name is Juliet Triumphant, and I help business owners register their business with PAC here in Nigeria invest wisely and make passive income, especially here in Nigeria. So if that sounds nice to you, go ahead to hit the subscribe button. Subscription is free, so please go ahead and hit it and like this video. Now let's dive. Profit after tax. The very first thing you need to check is profit after tax. This is the real profit a company makes after paying all expenses and taxes. Now think about this. A company can make billions in sales and still not be profitable, because if expenses are too high, the company may still struggle financially. So what you need to see is consistent profit growth. For example, if a company makes 10 billion naira in 2022, 20 billion naira in 2023, and 35 billion naira in 2024, that's a positive sign. But if profits are constantly failing or declining, that is a warning signal. Smart investors focus on businesses performing high and not just based on hype. Revenue growth. Now, the second thing you need to check is revenue. Revenue is the total money a company generates from sales or services. Healthy companies usually grow revenue steadily over time. For example, 100 billion revenue this year, 150 billion revenue next year. That means the business may be expanding. But here is the important part. Revenue alone is not enough. Some companies increase revenue while profits keep failing or decline. Why? Because their expenses are too high. So always compare revenue with profit growth. If they are still increasing together, that's usually a strong sign. Now, the next thing you need to check is the EPS. Let's talk about EPS. EPS simply means earnings per share. This tells investors how much profit belongs to each shareholder. The higher the EPS, the better it usually is. If EPS keeps growing yearly, that often means the company is becoming more profitable. And here is something important. Many institutional investors pay close attention to EPS before investing, because strong EPS growth can increase investor confidence and even push stock prices higher over time. So before buying any stock, always check their EPS if it's constantly growing. Now, the next thing you need to check is dividend history. Another major sign of a profitable company is dividends. Dividends are payments companies give to shareholders from their profits. Now, not every company pays dividends, but companies that consistently pay dividends are often financially stable, especially companies that increase dividends regularly for long-term investors. Dividend-paying stocks can create passive income. Imagine getting paid just for owning shares. That is one reason many investors love strong dividend companies. But if a company constantly skips dividends or reduces them frequently, investigate further. That can be a red flag. Check debt levels. Now, let's talk about something dangerous. Debt. Too much debt can destroy a company. Some businesses borrow so much money that most of their profits go into paying interest. That's risky. Now, debt is not always a bad thing. Some companies borrow money to grow, but smart investors check whether the debt is manageable. If profits are small but debt is massive, that's the warning sign. And always compare companies within the same industry. Naturally, banks carry more debt than manufacturing companies, so context also matters. Now, another major thing you need to do is to compare it with competitors. Never analyze one company alone. Always compare it with competitors. For example, if you want to invest in a bank, compare profit growth, revenue, dividend, debt levels, and share performance with another one. This helps you to identify which company is stronger financially, because sometimes a company may look good, but until you compare it with a better performing competitor, that is when you will know if it's actually doing good. Smart investors compare before they invest. Read annual reports. One thing that separates investors from gamblers is research. Many people buy stock because somebody online recommended them, but serious investors read company reports. Now, don't panic. You don't need to read all 200 pages. Even checking a few important sections can help. You can focus on revenue, profit growth, risks, future plans, debt, business outlook, and once you start reading them, you will understand companies much better. Serious investors read annual reports. Now, if you want me to show you how to get the annual reports of any company you want, go ahead and comment in the comment section annual report, and if I get at least 10 comments, I'm going to show you exactly how to get the annual report of any company of your choice. Check ROE. Now let's talk about ROE. ROE means return on equity. This shows how efficient management uses investors' money. Generally speaking, an ROE of 15% is often considered strong. High ROE can indicate efficient management and a profitable business. Now, this isn't the only thing to check, but when combined with strong profits and healthy cash flow, a good ROE becomes a powerful signal. This is one reason experienced investors pay attention to it. Now, the last one and the most important, avoid investing based on hype. This is the final point and it's extremely important. Never invest based only on hype. A lot of people buy stocks because everybody is shouting buy it, or because somebody online promised quick profits. That's dangerous. Smart investors study the numbers, they understand the business, and they invest with patience, because real investing is not gambling. It's about buying strong businesses and holding them for a long time. So before investing your money, always do your own research. Before buying any stock, ask yourself simple questions. Is this company making profits? Is profits growing? Is revenue increasing? Does the company pay dividends? Is debt under control? Does the company generate strong cash flow? If the answers are mostly yes, then the company may be worth researching further. If you enjoyed this video, don't forget to like, subscribe, and turn on notification for more investing and financial educational videos. Thank you so much for watching, and bye.